Today we just got initial insight into what the future could hold for the housing market and even the stock market for that matter for 2023 and 2024. We just got the latest reports for November's inflation, and what we saw was actually pretty shocking. Now I wanted to put out this video with less editing than I normally do because I wanted to give you the most up-to-date information of what's going on as this report just came out, and based on what we've seen, we can definitely expect that to have an impact on the future of the housing market. And that's exactly what I want to talk about in today's video. I'm going to talk about what we just saw in this latest inflation report and how that's going to impact the future of the housing market, including my predictions for what I expect to happen in 2023. But before I get started, do me a favor and support the channel by smashing that like button, and if you haven't already done so, definitely subscribe, hit that notification bell to watch more content like this. And with that said, let's jump into it. Alright, so the latest inflation report just came back lower than expected, which is a major win for the Federal Reserve because they've been trying to maneuver this soft landing, so to speak, which is basically when you're trying to tackle this inflation problem we have while trying to avoid entering an economic recession at the same time. Now, while the idea of a soft landing has been considered more of a long shot than anything, this is really starting to give the Federal Reserve hope that maybe this can actually be pulled off. As of right now, we are seeing the Federal Reserve tackle inflation better than expected, better than what many experts predicted would happen. But with that said, it is a lot easier to go from the high numbers we started at over 9% down to like a 7% than it is to go from a 7 to a 5% or even a 5% to a 3%. And don't forget that their ultimate goal is to get down to 2% levels. But what I want to do is I want to take a look at the bigger picture, and you can actually see the trend right here. Back in June, we were actually sitting at 9.1% inflation, and it's been steadily going down since. We hit 8.5% in July, we hit 8.3% in August, 8.2% in September, and we saw a pretty significant drop in October, which was the first signs when we started to see that some investors are maybe considering that the Fed might pivot sooner than expected. That's when we started to see stock markets rallying, we started to see the treasury bond yields falling, which ultimately had an effect on mortgage rates going down, making it a little bit more affordable than it has been in the previous months to buy a house. Well, that month was pretty significant because not only did it go down again for the month of October, but it actually beat expectations pretty significantly. And we wanted to see, will that trend continue? Not only go down again for the month of November, but will it beat expectations because expectations were a little more aggressive than they've been recently? Well, as you can see here, we were at 7.7% in October and it went down to 7.1%, but our expectations were 7.3%, which means once again we beat expectations. But what's very interesting is if you take a look at the month over month numbers, we only had 0.1% growth month over month, which if you annualize that, that's an annualized rate of inflation of only 1.2% yearly inflation. So that's a pretty big drop from where we were at last month, seeing about 0.4%, which is about an annual inflation rate of 4.8%. And so what we were expecting to see it drop down to 0.3% monthly inflation. That actually significantly beat expectations by hitting 0.1%. So that was again another major win for the Fed. I also want to take a look at what exactly has been affecting these inflation numbers. You can see here with food, we were as high as 1.2% monthly inflation in the month of May, went down to 1% in June, and gradually we've been going down to the point where we're at now 0.5% monthly inflation for the month of November. And that's also been helped by the cost of oil going down, which we see here with the energy side of things. Oil has been helping drive that down, but what we've been seeing is gradual decreases taking place, especially as they were releasing oil from the strategic reserves and things of that nature. And once again, we saw another decline in November, negative 1.6% for all energy, and specifically in gasoline, we saw negative 2% there. Another thing that stood out to me was used cars is significantly going down. You know, we saw that huge rise during the pandemic as there was a shortage of cars and all the chip shortages taking place and things of that nature, but we saw that as it's been going up, it's starting to go down now again, negative 1.1% in September, negative 2.4% in October, and now negative 2.9% 2% in November, and I'm thinking that it's going to go down even more in December time for used cars. I was speaking to a dealer just the other day, and they were telling me about how much it's already gone down as far as pricing is concerned for the month of December of what they've seen take place just in the last couple of weeks. So I really do believe that we're going to see that tank even further in the month of December when that data comes out in January. Now, the last thing I want to point out on this report is owner's equivalent rent. It's basically the government's way of tracking the cost of housing, although it's a very inefficient way of doing it because the way they do it is they call up random homeowners and they say, if you were to rent out your home, what would you rent it out for, not counting utilities and things like that? Well, many of these homeowners, because they're not landlords or they're not property managers or real estate agents, they're not very up to date on what's going on in the rental market. So when we saw rents surging like they did last year, many people weren't aware of that taking place, because if you just live in your home and you own it, then you're probably not very aware of what's going on in the market. Well, now it's starting to catch up as more people are aware that rents have gone up pretty significantly. This is why we're seeing such a huge delay in this number. And so as you can see here, owner's equivalent rent, I've told you that is probably going to stay pretty high for at least the short term. You see 0.7% month over month, 0.8%, 0.6%, and then for the month of November, it came in again pretty high, 0.7%, because again, it's a lagging indicator. It's a lagging data point in their statistics. And so even with that high, then it really is, because really right now rents are actually going down. So that only plays even more into the Federal Reserve's hands, because once that starts to finally correct and catch up with rents actually going down like they actually are right now, then that's only going to contribute further to seeing inflation levels going down. I also want to point out that core inflation came back better than expected. We saw it go as high as 6.6% for the month of September. Then it went down to 6.3% in October. Expectations were for it to dip down to 6.1%, but it actually came in at 6% flat, which again is another major win for the Fed. And the Fed really actually cares more about core inflation than they do regular inflation. And core inflation, for those who aren't aware, is your inflation not counting your food and energy. So what does this ultimately mean for the future of the economy and the housing market as a whole? Well, I think first we got to address the fact that the Federal Reserve is currently meeting right now. Some of you guys might see this video after they meet and after they've made their decision, but tomorrow they're going to be making a decision on the rate hike they want to do. I'm expecting that based on what we've seen, because remember, this is good news to the Federal Reserve. What they're doing is working better than expected, and so because of that, I think they're going to get less aggressive than they've been in the past. I think we'll definitely expect to see a 0.5% interest rate hike, and I think that the Federal Reserve is going to announce that they are going to pause on the rate hikes from that point on. I don't think we're going to see any more rate hikes taking place in 2023. Now, understand this is not over yet. The Federal Reserve has a long way to go in this battle with inflation, because again, it's a lot harder to beat inflation the lower the numbers get. Again, harder to get down from 5 to 3% than it is to get from 7 to 5%. So we'll see and monitor how that continues to go for them. But as of right now, their goal we know is 2% inflation. I don't think we're going to see it get to that point before they make a pivot. I think they're going to settle for anywhere from 3 to 4% inflation, and then at that point they will do a full U-turn. Now, who knows how long it's going to take to get to those 3 to 4% levels, but what I want to do is I want to talk about what this really means for the housing market. You see, as news broke of this inflation report, we saw stock markets rally, we saw treasury bond yields fall, basically a repeat of what we saw happen last month, which means that we saw mortgage rates go down again. We're currently at the lowest mortgage rates we've been at in over 3 months, currently sitting at 6.28%. And again, if we continue to see progress like this take place with inflation, we could potentially see mortgage rates continue to dip further. Now, that obviously has an effect on the housing market, because the more affordable houses are, the more that props up the housing market. Now, we're still a ways away from it being anywhere near affordable at this point. It's still very unaffordable, not as unaffordable as it was maybe a month or two ago, but really at this point, it's still at an unaffordable rate with 6.28%. So at this point, what I expect to see with the housing market, I do think we have further price declines to come in the housing market. For starters, we are still adjusting to where mortgage rates are currently at, even at the 6.3% levels. Remember, it's a lagging number, the median sales price. It It's normally about 2 to 3 months delayed, so we're going to have to give that time. It only started really coming into effect as of November. The second thing to really consider is there's still the forced seller element that I've been talking about on the channel, which is the builders, the iBuyers, and the investors. With builders, they're upping their incentives, they're still slashing prices. I know I've been getting emails firsthand from a lot of these builders that have been offering these slashed prices that just came out, again, just in the last couple of weeks in the month of December. So we're continuing to see that element take place with the builders. And it's really important to think, especially with the markets that have a huge concentration of these new builds, thinking like markets like Austin, that almost a third of their entire inventory are these new construction properties. They're going to experience more of the effects of these new comparables coming into place, because again, as these builders finally sell these properties that are so steeply discounted, they become the new comparable for the area, which that essentially affects the resale price of existing homes as well, especially if almost a third of your entire inventory on the market are these new builds that are getting so discounted. Another major thing to consider is the iBuyers, because iBuyers are taking a major hit right now. A lot of the properties they bought, they're currently selling and asking for a price that is less than what they purchased it for, which means they're taking a huge loss, and they're cutting their price reportedly by 2% on a bi-weekly basis. So it goes down every other week, it goes down further and further. And again, these are existing homes, so these become new comparables again for whatever area they're in. And again, markets like Phoenix that have the biggest concentration of iBuyers, that's going to be a very dangerous market, seeing a lot of price reductions take place, and that's why we're seeing prices decline in that market so significantly. So I think that ultimately nationwide, we will still continue to see prices decline from where they're at now. We're at 9% down from peak levels at this point. I think we could easily get to the point where we're at 15% down from peak levels. And if it gets worse again, we see mortgage rates go back up, it will definitely get worse from that point on. But if mortgage rates continue to decline from this point on, the news with inflation continues to be really good and do better than expectations, then we may see a limitation on how much we see prices decline. And I think that could be somewhere around 15% levels nationwide. Again, some markets are definitely going to feel it much worse than others. I think there's markets that are definitely destined to crash. Markets like Austin are already knocking on the door. Phoenix, a lot of these pandemic boom towns, Boise, Idaho, Las Vegas, Nevada is another one. Even some of those more expensive markets like San Jose, California, and Seattle, Washington. So what this news essentially means in a nutshell is we will still see price declines take place on a nationwide level. I still think we have further to go, but based on this could be an early indicator that we may see limitations to the downside compared to what we were expecting to see earlier on. Either way, things are changing rapidly one way or another. All it takes is a couple bad inflation reports and then things could be changing the other way around. So we're going to have to just continue to monitor what is going on with that. And as we get more reports back and more data back, we can get more insight into what's going to happen with the housing market throughout 2023. So with that said, if you enjoyed today's video and you gained some value from it, do me a favor and support the channel by smashing that like button. And if you haven't already done so, definitely subscribe, hit that notification bell to watch more content like this. Also, let me know your thoughts or questions in the comments below and I'll do my best to get back to you. Finally, follow me on Instagram and TikTok at The Out of State Investor. And if you enjoyed today's video, I'm going to highly recommend checking out one of these two videos over here. And with that said, I'll see you on the next one.